Hi there, and welcome to the bottom line. Creating this short video presentation for assessing an equity investment, primarily the one that I am interested in. I've been observing for a while now, and from all the aspects of finances, the business models, it is looking extremely lucrative at this point. So keep watching this video, and at the end of the whole analysis, I'll reveal the stock name. The most important reason why the stock name is at the end is for you to figure out how things are analyzed irrespective of which stock are we really analyzing. So go through the process of analyzing every stock without the name of it, but trying to understand what good financials look like, right? So let's begin. I have a few pointers to cover today. The first one is I believe that I should only invest in companies that are simple to understand, or rather are I should be able to explain their business in less than 90 seconds. If they're doing something too complicated where I'm not able to explain in less than 90 seconds, possibly that's not an investment idea that I would ever go ahead with, and that's where it kind of gets filtered out from my list. The second one is understanding financials with simplicity. You can do a financial analysis that can span across 500 pages of report, or you can do a financial analysis that spans across 5 slides, and that pretty much gives you what you need to have the confidence in that particular investment. We'll try and understand what is the basic correlation between earnings and price, and then try to relate it back to the stock in recent divergence that has come in its price and earnings. And finally, a quick few concluding statements. So, from a business in 90-second standpoint, this company manufactures machinery performance chemicals, and it also manufactures some FMCG chemicals. But performance chemicals form 70% of the revenues, so that's where the chunk of the business is. These these chemicals are basically used in machineries to improve their performance. Right, as simple as that. Uh, Most of the revenues come from outside of India. 70% of it comes as exports, so that's another good thing because then the company is earning in dollars, and the revenue is in dollars, and the expenses are in rupees. That's what you see mostly in the information technologies and services industry also. If we look at the debt to equity ratio and pure comparison, uh, the debt to equity of this company is lowest in all its peers, almost zero, or rather, it's fully zero because there's not even a little amount of borrowings on the name of the company, and yet it happens to perform extremely well. So, from a debt equity point standpoint and a peer comparison standpoint, it stands brilliantly in terms of uh, debt burdens, especially when we are in a scenario of interest rate hikes. That's when the debt burden companies are very likely to go into distress situations. If you look at annual profit and loss, I have marked the OPM, which is operating profit margin percentages, extremely good percentages of OPMs. That what it means is from every rupee of revenue that they get, uh, they are able to keep the profits of 44 paise from every single rupee of revenue that they make. Now that's a great operating margin. Of course, now this will come with other expenses which will eventually reduce it, but yes, that keeps the net profit healthy at all times, which you see right at the end of all of this at annual profit loss. uh, this statement gives me a lot of confidence in terms of how the company is doing. You will see numbers deviating a lot of times, but I'll come to it right at the end. If we look at quarterly profit and loss, again, great operating profit, great net profit. They have been increasing every single quarter, every year. They are trying to improve from where they were. And mind you, it's all being done at zero debt, zero loans. It's all equity money. And that is generating this kind of profit every single quarter. Now, that is not easy to do in an industry of chemicals where there are so many big players in the market already. If we look at the balance sheet, now balance sheet can have multiple areas, right? Reserves, equity capital, total assets, total liabilities, but I focus on majorly what are the borrowings, right? If somebody says it's a zero debt company, then the borrowings also have to reflect that, right? So if you look at the short term borrowings and the long term borrowings, they're almost zero. A 0.05 short term borrowing does not bother me, because the short term borrowings are a lot to do with uh, the revolving facilities that are important for the working capital of the company, right? Any long term borrowing additions from here on, yes, that was definitely put me into a situation of rethinking about this idea, right? But at this point where I'm looking at, there are no long-term borrowings. There are lease liabilities, but lease liabilities are something that could be cut down. They are very important for offices. It's better to have things on lease at times, especially in areas where you can't control a lot. For example, aircrafts on lease in airline industries is a very good idea to stay afloat in a tough market. And I take that with cash equivalents, which is also a very important element on the balance sheet. uh, what that gives me in terms of confidence is, in comparison to the borrowings, how much cash do I readily have? So at this point they only have about close to 12 crores. That's why I've marked it a little in red. But looking at where the borrowings were, the cash equivalents does not seem to be low at all. They are, in very big multiples of how much the borrowings are at this point. uh, Again, I've hidden the stock name for a reason, just to understand what stock and price divergence do. In You go in technical analysis, you go in fundamentals. One thing is going to stand out for everything that has a valuation in the market. One, the stock will either be undervalued as compared to its earnings, or it will be overvalued as compared to its earnings, right? Now there is a way to do that, is you can take a look at the price chart, and you can look at the EPS, or the net profit of the company, and you can plot it on the chart of the price. Now when I plot this particular stock, what I get to know is the price is well below the net profit line, right? Can you see the line in orange is what uh, typically indicates the net profit line. Now it's a handmade trajectory which is trying to depict to its best of where the net profits are. Now the point is that when this divergence happens, and this is a divergence that is positive for investing, is the earnings have moved ahead, but the stock price has stayed muted, right? If you look at all the way from the time it's listed in June 2021 all the way till today, the stock price has been muted as compared to its net profit growth. So from here, it is expected that it will converge with the earnings line eventually, right? And provided the earnings also keep increasing. The other case is that the earnings drop and then it converges with the stock line. But that's the risk that we always run in equity investing. But if you do the best of your financial analysis, that should not be a problem. With that, I think it's a few areas that I have touched upon in terms of balance sheet profit and loss, the stock price divergence, and this is what mostly I look at in terms of simplicity. This does not give me any kind of complexity in my investing, and I try to keep it very, very simple with these 4 or 5 pointers and understanding the businesses in simplicity. So the company that I have been talking about is Clean Science and Technology, right? And the Clean Science and Technology is the company that I will be looking at as an investment idea in the near future. I hope this was insightful, and this is what is the equity investing series is going to be. Whenever I find a good stock like this, I'm going to put this through the financial lens, try to understand the price and earnings divergence, and present it to all of you as one of my investment ideas. This is not a recommendation to buy, hold, or sell. Please make sure that you consult your financial advisor, or before you hit the button, you ensure that you are owning the risk. Once again, thank you so much for your time, and I'll see you in the next one. Bye bye.